Hello and welcome back to the Portfolio Podcast. On this week's episode, we're going to be talking about Rolls Royce. Now, they have a massive potential to hit back up to their pre-COVID numbers, but there's many reasons why they haven't done it yet. Stick around to find out. Rolls Royce is an amazing British company that you may know for making cars, but that is a while back now because now Rolls Royce are in two different companies. You've got Rolls Royce Limited and also Rolls Royce Motor Holdings Limited. Now, these are two different companies. The Motor Holdings Company is wholly owned by BMW and they're making the Rolls Royce vehicles like the Wraith and the amazing stuff that they do over there. But what we're looking at today is Rolls Royce Limited. This is their aerospace sector. They supply amazing companies around the world with incredible aerospace inventions and designs. So let's get into it. Rolls-Royce Aerospace is a master of research and development, and they have a great market share in the aerospace industry. They provide the likes of Boeing with their jet engines and other manufacturers around the world. They recently sold one of their businesses, ITP Aero, for £1.7 billion. This actually sent their stock price up a little bit, which was confusing to me at first, but after I had a conversation with Ryan, I understood why.
Yeah, absolutely.
They recently secured a multi-billion-dollar contract with the United States Air Force, so this is a really good forward look for Rolls-Royce. So a few of the cons of buying Rolls-Royce: the share price has not recovered to pre-COVID-19 prices. Now, this might look all bad at this point, but we can try and make it look a little bit better on the pros page. Rolls-Royce operate on what's called a pay per mile kind of system. When the planes are in the air, they earn money. With COVID-19, obviously, this model didn't look so good because the planes are on the ground. There was no holidays, and that's where all their money is. That's the majority of their earnings is from holidaymakers.
Yeah, I thought that was quite an interesting one. I wasn't aware of it at the time that Rolls-Royce. I thought it was a case of you sell the engine and they make the plane, and you get maintenance costs and stuff like that, and you do sell parts like you would do with a car for one way of doing it.
Yeah,
I didn't realise,
like all the guys that supply our company.
Yeah, because
they give us a product for a price and they charge us a maintenance fee.
Yeah, but I think it's the fact correct me if I'm wrong in saying that Rolls-Royce actually still own the engines and they almost rent them out is the best way to put it.
Yeah, so how I understand it is that there is a charge up front and then there's a pay per mile because of how much these systems cost to buy outright.
Yeah.
Because if I was Rolls Royce, I'd want to be selling at premium realistically, and that's kind of what they're doing. Because if they can make one engine last twice as long and charge per mile, then they're it's a very good system.
Yeah, I mean, I had a flick through the reports, and for the half year, they said I think they put something like 3.7 million run hours on the engines, but that 3.7 million run hours is only 40% of what it was in 2019. It's an astronomical amount of flight time.
Yeah. But on the other side of that, we're at, in reality, a little bit of a sale price right now. Now, obviously, we've got the rest of the presentation to go to for us to make our minds up, and also for you guys out there to think about whether this could be something for you guys to look into. But we're at a sale price. We're at a very low point in Rolls-Royce's share price history for the last sort of like 5 or 6 years. So this could be a perfect opportunity for myself to have some shares. And in fact, I have already bought 170 something shares in Rolls-Royce this week. Just disclaimer. The group is also planning on cutting 9,000 jobs and plans to shrink its sites in Derby, Singapore and Germany, and there's some other areas as well that they want to shrink slightly. They have already got through most of these. Approximately 8,000 have been cut.
Yeah.
Now, obviously, this does look bad on a company in a way because the media makes it look like they're devils, they're evil, and in a way, you kind of taking away 9,000 people's livelihoods. They've got to try and find somewhere else to work, and in the current climate with a lot of companies going through these sorts of redundancy packages and cuts, it makes it a bit harder.
It's one of both. It's a two-sided coin, really, that one, isn't it? Because you've got 9,000 people in the company that experience, they understand the systems and stuff like that. Now, I think they saved £1.2 billion so far by cutting that number of 8,000 of the 9,000 heads out of it. So it's great from an investor standpoint in terms of they need to right-size their company and they need to save a load of money. But in the long term, they're getting rid of a load of experience. They're giving experience over to their competitors. Those people might go work for Airbus now, and all of a sudden they've got all that
Exactly.
information and technology. And if they get rid of the wrong people, the experienced people, they're giving away some of the most powerful assets they have. So it's a two-headed coin.
Exactly. At the end of the day, intellect is one of the most it is the most important part of any company.
Absolutely.
These engineering and R&D companies don't survive unless we have like-minded thinkers that just want to see something improve. And you cut the wrong people, as you say, and your company can really be detrimented. So let's just hope that the cuts that they've made have been warranted and they haven't cut people that could be deemed necessary to the future. In March 2021, they actually said they put a media report out saying they'd lost 4 billion. Also, the dividend has not been stable one bit. In fact, in 2020, they paid out some non-cumulative penny stocks, which just baffled me.
Yeah, they're sort of things they do for management on certain sort of primary shares. They're not generally shares you can get in the general market.
those higher shareholders, the guys with thousands of shares.
Yeah. But they weren't worth much. The normies didn't get any dividends. They've not had any dividends 2019, 2020, none in 2021. And from what I was reading, they won't resume their dividends or consider resuming their dividends till January 2023. So it's...
Which isn't a massive problem in reality, because at the end of the day, they've had a good percentage dividend over those years of paying out. And this has affected them massively because they obviously can't pay a dividend right now. As you can see, they've stated a £4 billion loss.
The thing is, they also they have to cut their dividend in order to survive. It's the correct thing to do for the company. You can't warrant paying out a dividend if you're not making money. It's the way it works, unfortunately. So it's just about now trying to time it and say, right, again, the same as we looked at with Cineworld and other stocks, if the recovery's there and they're starting to recover and they're starting to have a positive cash flow again, right, when do you think that recovery is going to be completed by? When are they going to turn cash positive, and when are they going to start paying the dividends? So you can time it so you get a lot of the capital growth of the company coming back into the market properly again, and then you also get the dividends when they restart on a slightly later time frame.
At the end of the day, I don't think, as much as we are dividend investors, there's some part of us that has to go, I have a good feeling about this company and I trust that they are making the right decisions. And I've read through the stock reports and I do trust that they're making good decisions as directors and CEOs of the company.
Yeah.
And with their first half of 2021 doing much better, I think it does just give that bit of a, it gives me a bit of confidence in their company, which is why I put a small amount of money into them this week.
Yeah, they've got a strategic direction. That's the key thing. They've clearly stated where they're going, and they're clearly already delivering on it when you look at their first half report. So.
Exactly. At the end of the day, this is a sort of company that we're waiting for that one big year that will either be next year or the year after, where we see holidaymakers return into like over the top spending on their holiday, over the top. I want to go to Australia because I haven't been away for 3 years, kind of style stuff going on. And I think that sort of thing will come with COVID depleting in a reality. It's actually depleting in a lot of parts of the world, and also B, people don't care about it as much.
Yeah. One other thing I think you haven't got on the cons list, and I've just thought of really after watching the budget stuff that's been coming out this week, is that probably won't be a major impact, but the change in tax on long haul flights in the UK. So any flight over 5,500 miles now is going to have increased tax. Any domestic flights inside the UK are going to have decreased tax. Obviously, Rolls Royce mainly work in bigger jet engine sector, so obviously that might have a cut into their profit. Now it's only in the UK, so it's only a small proportion of their market, so I doubt it's going to have much of an impact, but it's an interesting change in the regulations. I think it's not changed for many years in the UK. So. But
as holidaymakers, we do a lot of miles in this tiny little country, and it does make up a significant amount of money for them. And at the moment they're not getting that money, so they decided that 10% pay cuts to some of the senior management would help them regain some of that loss, which it will, of course it will. But it kind of screams instability to me a little bit.
It's another double-headed coin, really. It's good for the investing world because they're doing cost cutting, but as you said, it's
what's nice to see is that they're not just putting 9,000 of the people like me and you, our sort of level of working in a company, out of jobs and not even considering taking out the senior management that is realistically costing the most amount of money. They are considering all layers of management, which is a nice thing to see. So the pros, so you'll see here I put some in red. That's because they're actually the same as the stuff that's on the cons list, because this operate on a pay when you fly system. That's going to pay off, as I say, when these holiday makers start really going at it for a year. Some people will start taking 2 or 3 holidays a year because they've missed out on them and they want to go on them. So this is going to be an amazing thing for people like Rolls Royce and the likes of Boeing and the other one,
Airbus.
That's the one. So yeah, it actually could make massive profit and boost this company back to, hopefully, for my shares, I'm hoping it boosts it back to almost pre-COVID share price, because that would be a nice capital gain. And with that boost, I would be hoping to see that dividend return in 2023. If not, at maximum 2024.
Yeah, but that's exactly right. I mean, there's a lot of pent-up demand. You are correct there. So provided things go the right way, I mean, we've just removed in the UK everybody off the red list, so you can fly to any country now. So that's a positive sign. There's probably still going to be some jubilations given the fact that COVID is still rising in most countries about people flying. But as it does start recovering, you're absolutely right. There's going to be a load of pent-up demand. Now they've right-sized the company and they've made it more efficient. If they start getting those fly hours back on, then their profit margins should be much greater than they were before, because they've had to do something. They've been forced in a play to do something which could make them a more profitable company in the future. So as long as COVID goes in the right direction.
The only problem currently is that so Germany has us on their high tier list, which means it's hard to travel to Britain. So there's some European countries that are saying no to us. Because we have a very high R rate still, and one of the highest in Europe, in fact, and that is going to be a downside to us when we come to these holidays starting to come back. Some of these countries are just going to say no to us, which then also affects places like Rolls Royce, because those, small country, little UK over here, but it's still money.
Exactly. But the thing is, we're both talking on a UK scale on this. Obviously, this is a global company, so it's not just what the UK is doing in terms of rules and regulations on travelling. It's a global situation. What's the global?
It's the world.
global pandemic situation covering.
So as you can see there, I've also put in about the 9,000 job cuts. Now this is actually a pro as well as a con. Yes, people are losing their jobs, very sad, and I do feel for these people genuinely, but the company's looking out for itself, because the company needs to survive. That's their whole aim in this. And 9,000 jobs being cut is a lot of money per year being saved. You say it's 1.2 billion a year.
1.2 billion is the target for it, and they're cutting 9,000 jobs, but by cutting 9,000 jobs, they're ensuring that another, I think it's 38,000 stay employed. So
exactly.
Would you rather lose all of the jobs or only 9,000?
They're also looking at over a more than $1 billion in cash savings in 2020 from one-off mitigating actions, which means that they've done small changes that have ended up equating to over £1 billion in savings. On top of this, they also sold the aero company in Spain for 1.7 billion. So they are starting to kind of save money compared to the debt that they're already, the losses they've already suffered. So this 4 billion hopefully will be wiped away in the coming, I want to say months, let's say coming few quarters. And the first half of 2021 has been pretty successful. The analysts and experts estimated a profit, and Rolls Royce have succeeded that by over 500 million past that point. So, £500 million extra on top of estimates is nothing to be grumbled at.
No, it's good to see them numbers going in the right direction. They hadn't made a ton of profit since, I think it was 2007.
I just want to have a quick look at their share price. As you can see, that since 2020 with the COVID crash, you can see the crash. It did also dip more in 2021, obviously because that just longevity of not being able to have flights come off the ground, and also still having to pay those what's left of their staff, the 38,000 odd people. Recently, you can see an uptick if you come more towards the end of the graph. It's a very small uptick on the graph, and that was actually due to selling ITP Aero. It sold. They got 1.7 billion out of it, and people went a bit crazy with buying Rolls Royce for a few seconds. I have bought on a slight downtick since then, and I'm hoping that we can hit that pre-2020.
Yeah, it's going to be linked to their report as well, because
yeah.
that looks about August time, doesn't it? And August is when the half-year report came out. So when they've started posting profits again, obviously that's good market news, and share prices will climb on according to that news. But obviously, part of returning to profit was disposing of that company, as you specified.
So the forward look then, guys. Obviously, we're not telling you what to do. We don't want to be. We're not financial advisors. But we have seen, I think I have seen at least a nice company that is looking and has plans to change things, unlike some of these wishy-washy annual reports to say, we're going to go green, we're going to go carbon neutral. These guys have actually got what seems like an actual plan. And that's what I like to see in a company of this sort of magnitude. So let's just quickly go through this. We've got the earnings in the first half of 2021 promising. Historic dividend, we've had a look at those and also looked at the EPS across those years, and on average it's around 2 times the historic dividend, which is a nice payout ratio for when we get back to that area of the company, that time in the company that they're going to start paying dividends again.
So that EPS was from this first half, wasn't it? Was the EPS for this first half?
The EPS is based on this first half. First half recovery does look promising, and we will need to wait for the next quarterly report for confirmation, so I won't be putting in massive money until I see the quarter report and see that things are going in the right direction. And then you're going to look at the debt pile as well, the 4 billion, and see how much of that is kind of being paid off. Currently, they estimate around 2 billion of disposals to pay off half of that debt pile. Anything to add, Ryan?
I mean, yeah, I saw a nice graphic on one of their financial reports they put out about that disposals and how they were trying to return to a positive cash flow. So of their £4 billion debt pile, pay off 2 billion with disposals, and they're also looking at another £2 billion in defence contracts coming in as well, additional on top of the ones you've already mentioned as well. That writes off their 4 billion.
So that takes us above it.
Exactly, should hopefully turn to positive cash flow. Now, again, they're not in stone yet. They're things that are supposedly supposed to happen, but at least they've identified those actual sections where they're hopefully going to generate that cash flow.
So final thoughts then. It's a really big and exciting British company that supplies one of the big 2 plane manufacturers in the world, and they have a great system for income. I love the paper flight idea. It's just a shame that COVID happened for them, because if it wasn't for that, they would have maintained a very nice share price. They would have maintained a very nice business plan throughout. It's just really is just a shame that this happened for them, if I'm honest. They do make one of the best plane engines in the world, and that's why they've won the US Air Force contracts. At the end of the day, the US Air Force aren't going to settle for second best. No. Obviously, their dividends are not consistent, and there is a nice potential for that capital gain. And yes, we're dividend investors, but that capital growth can be very nice in our accounts at the end of the day. If you could even just 1.5x your investment into Rolls Royce, I mean that's pretty great, if I'm honest. I wouldn't actually mind getting a non-cumulative redeemable shares in lieu of a dividend. Yes, they don't have a great value, but they do have value. Yeah. And they are sellable.
I don't think they'll offer them on the normal shares though. They're only on the C shares, and then
probably
the C shares aren't publicly traded. So it's only the managers that get those. Those are rewards.
But if I get enough of them, if I get enough shares, they might offer me some.
No, I doubt that.
So Rolls Royce, I think a pretty great company going through some financial hardship. Job cuts, not great, but also great for the company. And overall, that's the reason that I've put a little bit of money into their shares, because I do believe in their future and in their legacy.
Personally, for me, I don't think I'm ready to jump in on it just yet. I want to see more positive return to growth, but that's me being more risk-off averted towards it. Liam obviously decided now's the time to jump in because he can capture more of the capital growth if it goes in the right direction. For me personally, because the dividend isn't going back, potentially not even going back till way after January 2023. That's just when they said they might start considering it. It's probably one for me to hold off and wait on a little bit more. Yes, okay, if they are growing and they are recovering, I'll lose out on more of the capital growth, but ultimately for me, I'm not willing to take that risk with inside my portfolio at this current moment.
So guys, I want to thank you for watching another episode of the Portfolio Podcast. If you've enjoyed the video, please don't forget to like and subscribe to help us out. It really does help us out, by the way. And finally, what's something that was mentioned a couple of videos ago on a comment. We do have a Discord. Please have a look in the link in the description and join our community. It's not a massive community currently, but we aim within the next year or so to create that into the Portfolio Podcast Discord that will help you with your investing journey. See you later, guys.
See ya.